Welcome to the Deep Dive. We're here to help you cut through the noise on the most critical earnings calls. Today, we're digging into Kirby Corporation, that's NYSE COEX, their second quarter 2025 results.
Yeah.
And look, this isn't just a numbers rundown. We really want to unpack what moved the market here and, why it matters for you.
Exactly. We're going through the details, the management tone, all of it to give you that clear picture. Because this Kirby call, it was fascinating. You had this real tension.
Yeah.
Strong operational performance, even beating expectations in places.
Right.
But then this surprisingly cautious outlook. And that just sent the stock tumbling.
A classic beat, but the stock drop situation.
Precisely. And we're here to explore why that happened.
Okay, so let's hit those headline numbers first, just to set the stage before we dive deeper. Kirby's Q2 25, they reported GAAP EPS of $1.67.
Okay.
Which is actually a pretty healthy 17% jump year over year. And it was a modest beat against consensus too, right? Around $1.65 or $1.66.
Yeah, slight beat there. And revenue also came in a little ahead, $855.5 million.
Right.
That's up almost 4% year over year compared to estimates maybe closer to, say, 847 to 852 million.
Yeah.
So, yeah, top line looks solid.
So solid numbers. What about underneath that? Things like cash flow, EBITDA.
Also looks pretty good, actually. Their non-GAAP EBITDA, which gives you a sense of core profitability, was strong. $202.2 million.
Nice jump from last year.
Definitely up from about $183 million year over year. Operating cash flow was decent at $94 million.
Mm-hmm.
CapEx, they kept that at $71.5 million.
Okay.
And for anyone watching capital allocation closely, they bought back stock, about $31.2 million worth.
At what price level?
Average price was around $94.01 per share. So, looking purely at the numbers, it really did look like a strong quarter.
Sounds like it.
But yeah, the market narrative shifted quickly.
All right, let's unpack that operational story then. Let's start with the two main segments. Marine transportation, that's the big one, right?
That's the larger piece, yeah. Revenues there were $492.6 million.
And you mentioned something interesting about margins earlier.
Yes, the segment margin. It expanded to 20.1%.
Up from 19.6% last year. That seems really robust, especially now.
It was robust. And that margin expansion is absolutely key here.
How'd they manage that?
It really came down to utilization. Their barges were just full.
Really?
Yeah, inland utilization was holding strong. Think low to mid 90% range.
Okay.
And coastal was even tighter. Mid to high 90s. Basically, ships were booked solid.
Wow. So that gives them pricing power.
Exactly. Management pointed right to disciplined pricing and strong contract renewals. Inland prices were up low to mid single digits.
Recent?
But coastal renewals, they surged mid 20% year over year.
Mid-20s?
Yeah. It just shows how tight supply is, especially on the coastal side. They can really command those prices.
Okay, so marine transportation sounds like it was firing on all cylinders. What about the other side, distribution and services?
Right, D&S. That segment brought in $362.9 million in revenue.
And margins improved there too, didn't they?
They did, up to 9.8% versus 8.7% last year. But this segment, it's kind of a tale of two, sub-segments really.
How so?
Well, on one hand, you had really strong demand in power generation. Revenue there was up 31% year over year. Huge jump.
31%? What's driving that?
Mostly data centers and other industrial customers, too. It's become a massive tailwind for them.
I bet.
Their backlog for power gen reportedly grew another 15% to 20% just in this quarter alone.
So massive demand still building there.
Absolutely. But then the other side of the coin, oil and gas.
Not so good.
Revenue there actually fell, down 27% year over year, mostly due to softness and conventional activity.
Okay, that's a big drop. So margins must have gotten crushed there.
And this is where it gets really interesting. No, despite that 27% revenue decline, operating income for oil and gas actually surged.
Wait, what? Income up?
Up 182%.
How? Revenue down 27%, income up 182%. That doesn't compute.
Right. It sounds crazy, but it speaks volumes about their execution. It was largely down to really strong cost management, plus deliveries of higher margin EFRAC equipment.
EFRAC, electric fracking gear.
Exactly. It's a higher value growing niche. So they pivoted effectively, managed costs tightly, and actually squeezed out huge income growth even as the top line shrank in that specific area.
That's actually pretty remarkable execution. It shows some serious operational skill.
It really does. It highlights that strategic pivot and, frankly, very effective cost control in a tough spot for that subsegment.
Okay, so let's recap. Marine transportation, strong margins, tight utilization, great pricing. D&S, power gen booming, Oil and gas revenue down, but income way up due to smart management. Sounds pretty positive overall.
Operationally, yes, very solid.
But here's the turn, right? Despite all these seemingly good results, management's commentary, their forward look, it got cautious.
That's exactly it. They called it another solid quarter, which is fine. But then they introduced some significant caution for the full year.
And this is what spooked the market.
This raises the core question. Why the massive negative reaction? Their full-year EPS growth outlook, technically it remained the same, plus 15% to plus 25% year over year.
Which still sounds pretty good.
It does. But, and this is the crucial but, management explicitly warned, they said that recent trade policy shifts and near-term demand softness, those things could push results toward the low end of that range.
Ah, so they didn't cut the range, but they pointed to the bottom of it.
Precisely. That shift in tone, that specific highlighting of downside risk because of external factors.
Yeah.
They clearly hit investor sentiment hard. It wasn't the past performance, it was the cloud they painted over the future.
And the market reaction was immediate and severe, wasn't it?
Pre-market, the stock was already signaling trouble, down anywhere from 6% to like almost 19% in indications.
Wow.
But by the time the market closed that day, July 31st, Kirby shares were down roughly 22%. Settled around $93.21.
20%. That's the biggest drop since 1987, I read.
That's right. Biggest percentage decline in decades. And it happened on heavy trading volume, too. So it wasn't just a few sellers. There was real conviction there.
But is that reaction proportional? I mean, pointing to the low end of a still positive growth range, causing a 22% drop, especially with the power gen strength you mentioned.
That's the debate, isn't it? The street's takeaway was pure beat but stock drops.
Right.
Concerns were definitely centered on that lower-end guidance bias. Plus, they expected inland barge utilization to ease a bit in Q3, maybe down to the low 90% range.
Okay, a slight softening.
Yeah, and maybe some spot pricing pressure along with that.
Yeah.
So you have this clear split. Management tried to highlight long-term strengths, the coastal momentum, that power gen backlog.
Which sound pretty compelling.
They do. But the market, it zeroed in on the near term, the potential softness, the macro noise around trade policy. And in this environment, uncertainty just gets punished severely in this case.
So, stepping back from the immediate reaction, what does this tell us about Kirby's strategy overall? They seem to be trying to balance things out.
Yeah, they're actively working to reduce that cyclicality through their business mix. You see it clearly.
How so?
Well, marine transportation is really cashing in on tight supply and pricing power, particularly coastal. That's one engine.
Okay.
Meanwhile, D&S is leaning heavily on that power gen boom to offset the slump in conventional oil and gas. It's a diversification play in action.
It shows their innovation is more commercial and operational rather than, say, R&D focused.
Exactly. They're masters of optimizing what they have and seizing market opportunities. That is their edge.
But those external factors, the trade policy stuff, that's a real wild card, isn't it?
It is. They flagged it themselves. It's complicating chemical flows for the marine segment and apparently even sourcing for power gen equipment. So that could definitely put a cap on near-term upside, no matter how well they execute internally.
What about their financial position? Debt, capital allocation?
Pretty solid there.
Yeah.
Debt to cap ratio is manageable, around 24.8%, and they were clear about returning cash to shareholders via buybacks, especially since they aren't seeing big M&A opportunities right now.
Buying back stock around $94.
Right. Which signals their own view of value. That financial strength gives them flexibility, which is crucial when you're navigating the kind of uncertainty they flagged.
Okay, so looking ahead then, if you're watching Kirby, what are the key risks and maybe potential positive catalysts?
Key risk. Well, labor inflation's always there. The ongoing shortage of mariners could constrain capacity. And specifically, that near-term easing in inland utilization we talked about for Q3, if that weakens pricing too much, that's a risk.
Got it. And on the flip side, catalysts. What could drive the stock higher?
You'd want to watch that Q3 utilization and pricing in inland marine closely. Does it stabilize? Does it rebound?
Okay.
Also, the pace of those power gen orders. How quickly does that big backlog actually turn to revenue and profit? That's key.
Right.
Any positive news or clarity on trade policy would likely help too, easing chemical flows or sourcing issues. And of course, any updates on capital allocation, like more buybacks.
And the stock did bounce back a bit after that initial plunge, didn't it?
It did, yeah. The market's sharp reaction kind of creates an interesting setup. If things just stabilize or if we see any incremental positive signals, you could see a further rebound. By August 6th, so about a week later, the shares were already up about 7.2% from that low point, around $93.
So some recognition maybe that the initial sell-off was overdone?
Potentially. Or just bargain hunting. But it does show how volatile sentiment can be.
This whole Kirby situation really feels like a textbook example of how wider market sentiment, the macro picture, can just amplify reactions, doesn't it? Marine transport cyclicals, they've been facing headwinds from trade worries for a while.
Absolutely. And Kirby walked right into that cautious tilt on guidance, mentioning trade policy specifically. It hit a nerve in a market already worried about those things.
Even with credible operational results.
Exactly. It shows how much the market prioritizes future certainty, especially in cyclical sectors. Past performance gets discounted fast if the outlook feels shaky. It's a good reminder, even for seasoned investors, that understanding the why behind a stock move is just as critical as knowing the what.
Okay, good point. Right, let's pivot. It's time for our This Is Not Financial Advice segment.
The fun part.
Where we brainstorm an outrageous but maybe plausible trade idea based on everything we've just discussed. Imagine we're pitching this to the investment committee. So, given Kirby's situation, big drop after earnings despite the operational beat, that quick 7.2% bounce, the power gen strength, management buying back shares. I think there's an angle here. What's your pitch?
Okay, committee, here's the pitch. The market, in my view, clearly overreacted to the possibility of hitting the low end of guidance. That 22% drop, excessive. It spiked implied volatility in the options market.
Making options premiums richer.
Exactly. So, my idea. Let's initiate a short put spread on KEX.
Okay, specific strikes and expiration.
I'm thinking we sell the KEX October 90 put, and at the same time, we buy the KEX October 85 put for protection.
So sell the 90, buy the 85 for October. The stock bounced to maybe around $100, hypothetically, after that initial drop. Why this structure?
Okay, so a short put spread for anyone listening means we collect the net premium up front. We profit if KX stays above $90 by October expiration. Our maximum loss is limited to the difference between the strikes minus the premium received if it falls below $85.
Right. It's a defined risk, defined reward strategy, betting on limited downside.
Exactly. We're betting on stabilization or a continued grind higher. We're saying the $90 level looks like a pretty solid floor, given the operational health we discussed, especially power gen, and importantly, management's own signal of value by buying back shares around $94.
So the buyback provides a bit of a psychological and maybe actual floor.
I think so. We're essentially selling that inflated volatility, that fear premium. It's a bet that the initial panic was overblown and the fundamental value provides support. It's not a moonshot trade. It's about collecting premium based on a high probability assessment that the $90 level holds, capitalizing on that exaggerated fear.
Interesting. A calculated bet on stabilization and value using the options market structure. Okay, pitch made. Remember, everyone, that was strictly not financial advice.
Definitely not. Just brainstorming based on the data.
All right, so let's wrap up our deep dive on Kirby's Q2 2025 earnings. What are the key takeaways?
Well, we saw a company putting up solid operational numbers, beats on revenue and EPS, real strength in coastal marine, thanks to tight markets and pricing power. And that booming power generation business in D&S, driven by data centers, is a major positive story. But it was management's cautious tone that stole the show, pointing to the low end of guidance due to trade policy shifts, near-term demand softness that overshadowed the good results.
Leading to that huge, though partially reversed, market sell-off.
Exactly. It just underscores that delicate dance between current performance and future guidance in shaping how investors feel, especially right now.
Absolutely. And as always, please remember, everything we've discussed here on the deep dive is for informational purposes only. It's definitely not financial advice.
Please do your own research and analysis before making any investment decisions.
We really hope this deep dive into Kirby Corporation gave you some valuable context and maybe a different way to think about these earnings reactions.
Yeah, thanks for tuning in. We appreciate you listening.
Join us next time for more earnings call breakdowns and market insights. Until then, keep digging into the numbers. Provocative thought for the listener. Provocative thought for the listener. If the market continues to penalize companies for cautious near-term outlooks despite strong long-term fundamentals and disciplined capital allocation, are we entering an era where buying the dip on perceived overreactions becomes a more reliable strategy for value creation? Or is it actually a deeper signal of underlying systemic risks we shouldn't ignore?